For most people, democracy carries a simple promise. If the economy is failing, vote the leaders out. If inequality is rising, elect a different party. If living standards are falling, choose new faces with better ideas. Elections are supposed to be the mechanism that aligns economic outcomes with public will. That belief is so deeply embedded that it is rarely questioned. When life gets harder, the assumption is not that the system itself is constrained, but that the wrong people are in charge. Yet, when you step back and look at the data over decades, an uncomfortable pattern emerges. Governments change. Parties rotate. Ideologies campaign against one another with intensity. But the core economic trajectory barely moves. Debt rises under conservatives and progressives alike. Asset prices inflate regardless of who wins. Inequality widens through left-wing and right-wing administrations. Wages lag productivity in almost every advanced economy, election after election. The promise of choice collides with a reality that feels eerily predetermined. Take the United States, the clearest case study. Since 1980, the presidency has switched between Republicans and Democrats multiple times. Congress has flipped control repeatedly. Yet federal debt tells a straight-line story. In 1980, us federal debt stood at roughly $900 billion, about 30% of GDP. By 2000, after Reagan, Bush, and Clinton, it had risen to $5.6 trillion. By 2008, under George W. Bush, it reached $10 trillion. By 2016, after Obama, $19 trillion. By 2020, $23 trillion. By 2024, over $34 trillion, more than 120% of GDP. Different parties. Same direction. The same pattern holds for deficits. Republican administrations campaign on fiscal discipline. Yet Reagan tripled the national debt and George W. Bush turned a surplus into chronic deficits. Democrats campaign on social investment and fairness. Yet deficits expanded under Obama and exploded under Biden during crisis periods. The ideological language changes, but the fiscal result converges. Red or blue, the state spends more than it collects, year after year. Now look at inequality. From 1980 to today, the share of wealth held by the top 1% in the U.S. rose from roughly 23% to over 32%, according to Federal Reserve data. This rise spans conservative deregulation, centrist third-way politics, and progressive rhetoric. The bottom 50% saw their share stagnate or decline across the same period. Elections happened. Inequality kept compounding. Asset prices tell an even clearer story. The S&P 500 rose from around 120 in 1980 to over 4,800 by 2024. That includes crashes, recessions, and recoveries under every political configuration imaginable. Housing prices show a similar trend. The Case-Shiller Home Price Index roughly tripled from the mid-1990s to the 2020s. These gains overwhelmingly benefited asset owners, not wage earners. Whoever won the election, asset inflation remained the system's dominant feature. Europe shows the same illusion, just with different accents. In the UK, conservative and Labour governments have alternated power for decades. Margaret Thatcher privatized and deregulated. Tony Blair promised a new social compact. David Cameron preached austerity. Boris Johnson spent massively. Through all of it, British public debt rose from around 40% of GDP in 1980 to over 100% after COVID. Real wages stagnated for most workers after 2008, regardless of who governed. Housing became unaffordable under both parties. The outcomes differed in tone, not in trajectory. Southern Europe makes the pattern even more explicit. Greece voted in left-wing Syriza in 2015 on a mandate to end austerity. The result was not a new economic path, but a standoff with creditors. Within months, capital controls were imposed, banks were shut, and the government reversed course under pressure from bond markets and the European Central Bank. The voters chose differently. The economy did not. Italy cycles governments at a pace that borders on absurd. Populists, technocrats, nationalists centrist dozens of coalitions in a few decades. Yet Italy's debt remains stuck around 140% of GDP. Productivity growth remains near zero, and youth unemployment remains chronic. The political theater changes. The constraints do not. This raises a disturbing question. If elections genuinely determine economic outcomes, we would expect clear divergences. Countries voting for higher spending would see debt stabilize or fall through growth. Countries voting for austerity would see leaner states and stronger balance sheets. Parties that promise to help workers would deliver rising labor share of income. Parties that promise to protect savers would deliver stable currencies and low inflation. Instead, we see convergence around the same problems: rising debt, rising asset prices, rising inequality, and falling trust. Polling data reflects this disconnect. In the U.S., Gallup surveys show trust in government falling from over 70% in the 1960s to under 30% today. In Europe, Eurobarometer surveys show similar declines. Voters sense that something is off. They keep voting, but fewer believe that voting changes their economic future. Participation becomes an act of hope or habit, not confidence. Crucially, this is not because voters are ignorant or apathetic. It is because the system presents elections as decisive while quietly limiting what can actually change. Campaigns focus on personalities, scandals, and cultural conflicts because those are areas where divergence is allowed. Economic fundamentals are framed as technical, unavoidable, or responsible governance. When promises collide with constraints, constraints always win. This creates a subtle but powerful illusion. Citizens are told they live in free, democratic economies where choice determines outcomes. In reality, they are choosing managers for a system whose core rules are already set. The rules of debt issuance, capital mobility, currency management, and market confidence sit above electoral politics. Elections operate inside those boundaries, not over them. Part 1 is not about claiming democracy is fake or meaningless. It is about identifying the gap between expectation and reality. The illusion of choice does not require conspiracy or bad intentions. It emerges naturally when modern economies become too large, too indebted, and too financially integrated to be steered by voter preferences alone. People vote expecting economic change. They get continuity instead. Once you see this pattern, a deeper question becomes unavoidable. If elections do not meaningfully alter economic outcomes, where does real economic power actually reside, and why are governments across ideologies forced into the same decisions, even when voters demand the opposite? Modern governments like to present policy as a menu of choices: raise taxes or cut them, spend more or spend less, stimulate growth or fight inflation. During campaigns, these choices are framed as moral decisions driven by ideology and leadership. In reality, most of these choices are already constrained before a single vote is cast. By the time a new government takes office, the range of possible economic actions has narrowed to a corridor so tight that different parties often end up walking the same path. The first and most important constraint is debt. Once a state accumulates large amounts of public debt, its primary obligation is no longer voters but creditors. Interest payments become non-negotiable. In the United States, federal interest costs were about $200 billion in 2015. By 2024, they exceeded $1 trillion annually, rivaling defense spending. This is money that cannot be redirected to healthcare, infrastructure, or tax cuts without triggering larger deficits and more borrowing. No election manifesto can repeal compound interest. High debt transforms politics into accounting. A government can promise generous social programs or aggressive tax reductions, but if the bond market doubts its ability to finance them, yields rise. Higher yields increase borrowing costs, which worsen deficits, which require even more borrowing. This feedback loop punishes deviation. Politicians learn quickly that responsible policy is whatever keeps bond yields contained, not whatever won the most votes. This is why the bond market is often described as a shadow electorate. Unlike voters, it reacts instantly and continuously. Investors do not wait 4 years to express dissatisfaction. They sell. When they sell, Prices fall, yields rise, and governments feel pain within days. In 1994, US Treasury yields surged after bond investors lost confidence in fiscal and monetary policy, forcing the Clinton administration into deficit reduction despite campaign promises. In 2022, UK gilt yield spiked after Liz Truss announced unfunded tax cuts. Within weeks, the plan was reversed and the Prime Minister resigned. The voters had not changed their minds. The bond market had. Central banks formed the second constraint. Although presented as independent technocratic institutions, their role places hard limits on elected governments. When inflation rises, central banks tighten financial conditions, regardless of political preferences. When financial markets seize, they inject liquidity to prevent collapse, regardless of ideology. Governments can complain, but they cannot override these mechanisms without risking currency crises or capital flight. The European Central Bank makes this especially clear. Eurozone governments do not control their own currency. They borrow in euros they cannot print. This strips elected officials of one of the core tools of sovereign policy. During the Euro crisis, countries like Greece, Spain, and Portugal learned that elections did not grant monetary autonomy. Voters could reject austerity at the ballot box, but unless the ECB agreed to support their bonds, the banking system would fail. Faced with that reality, governments capitulated. Democracy met arithmetic, and arithmetic won. Global capital mobility is the third constraint. In a world where trillions of dollars move across borders at the click of a mouse, governments must compete for confidence. If taxes rise too aggressively, capital relocates. If regulations tighten too fast, investment slows. If deficits expand without credible financing, currencies weaken. These reactions are not theoretical. They are observable and immediate. Countries that ignore them face capital outflows, inflation, and recession. This is why economic policy across advanced economies has converged. Corporate tax rates have fallen globally for decades. Not because every government independently decided to favor corporations, but because mobile capital forces their hand. In 1980, the average corporate tax rate in OECD countries was over 45%. By 2023, it had fallen below 25%. Left-wing and right-wing governments participated in this decline, not because of shared ideology, but because of shared constraints. Trade agreements and international institutions reinforced this narrowing of choice. Membership in the World Trade Organization, trade blocs, and investment treaties limits what governments can subsidize, restrict, or protect. Violating these rules invites retaliation, lawsuits, or exclusion from markets. Elections do not rewrite these treaties. They merely change who administers them. Even social policy, often seen as a domain of democratic choice, is shaped by these pressures. Generous welfare systems require sustained funding. As populations age and growth slows, the tax base struggles to keep up with promises made decades earlier. Governments face a trilemma: raise taxes on labor, cut benefits, or borrow more. Each option carries economic penalties. Most choose a mix that preserves stability rather than fulfilling campaign ideals. This is why radical economic promises rarely survive contact with office. Candidates run against the system. Once elected, they become its managers. The state is no longer a vehicle for transformation, but a risk management institution. Its primary objective becomes preventing collapse, not pursuing voter-driven redesign. None of this requires corruption or bad faith. Structural constraints operate regardless of who is in power. A progressive government that ignores bond markets will crash just as quickly as a conservative one. A nationalist government that defies capital flows will face currency depreciation and inflation. The system disciplines ideology through financial pressure, not political debate. The result is a form of policy determinism. Governments appear to choose, but in practice they respond. Elections decide the style of response, the rhetoric, and the distribution of pain at the margins. They do not decide the underlying direction. Debt must be serviced. Markets must be reassured. Currency stability must be maintained. Growth must be coaxed from increasingly exhausted tools. By the time voters are called to the polls, The economic script is already half written. Politicians can promise change, but only within boundaries enforced by creditors, central banks, and global capital. When those promises collide with structural reality, reality prevails. Understanding this is crucial because it shifts the question. If governments across ideologies are trapped by the same constraints, then blaming individual leaders misses the point. The real issue is not who governs, but what governs them. If structural constraints explain why governments struggle to act freely, they do not fully explain why policies so often look identical across parties that claim to be ideological enemies. To understand that convergence, you have to follow the money behind elections, not in a conspiratorial sense, but in a systemic one. Modern political systems are expensive machines, and the sources that finance them shape what is politically possible long before voters enter the booth. In the United States, federal election cycles cost billions of dollars. The 2020 election cycle alone exceeded $14 billion in total spending, according to Open Secrets. Campaigns, super PACs, lobbying operations, legal teams, advertising infrastructure, none of it runs on volunteer enthusiasm alone. It runs on capital. And capital does not donate neutrally. The largest political donors are not workers or small businesses. They are corporations, financial institutions, industry associations, and ultra-high net worth individuals whose wealth is overwhelmingly tied to asset prices, tax treatment, and regulatory outcomes. These donors do not need to agree on culture or rhetoric. They need predictability. They need policies that preserve capital mobility, protect asset values, and socialize downside risk during crises. This is where the phrase different parties, same donors stop sounding like a slogan and start looking like a statistical pattern. Wall Street is a useful example. Over the last several decades, major banks and financial firms have donated heavily to both Democrats and Republicans. Goldman Sachs, J.P. Morgan Chase, Citigroup, BlackRock, none of them bet on a single party. They hedge politically, just as they hedge financially. The payoff is not favoritism toward one ideology, but insulation from structural threat. When crises hit, the response is remarkably consistent. In 2008, under a Republican administration, the U.S. government committed trillions in guarantees, bailouts, and liquidity programs to stabilize the financial system. In 2020, under a Republican president and a Democratic Congress, the response was even larger. The Federal Reserve expanded its balance sheet from $4 trillion to $9 trillion in under 2 years. Congress authorized multi-trillion-dollar relief packages. The mechanism differed slightly. The outcome did not. Banks survived. Asset prices recovered rapidly. Inequality widened. Voters argued over stimulus checks and culture wars, while the core financial architecture remained intact. This was not because politicians secretly colluded in a room. It was because both parties depended on the same financial system functioning and on the same donor ecosystem to remain electorally viable. Lobbying formalizes this influence. In the U.S., corporations and trade groups spend over $4 billion annually on lobbying. These efforts are not about persuading voters. They are about shaping legislation before it becomes visible. Technical language, regulatory details, carve-outs, and exemptions are written with expert input, often from the very industries being regulated. This is known as regulatory capture, and it is not a fringe theory. It is a documented feature of modern governance. A clear example is tax policy. Campaign rhetoric on taxes is dramatic. In practice, the tax code grows more complex, not more redistributive. Loopholes remain. Capital gains are taxed more favorably than labor in most advanced economies. Offshore structures persist despite public outrage. Presidents change. The effective tax burden on large asset holders remains historically low. Another example is military and defense spending. In the U.S., defense budgets have grown under both parties. Barack Obama campaigned on ending wars, yet military spending remained near Cold War levels. Donald Trump criticized endless wars, yet increased the Pentagon budget. Joe Biden oversaw further increases. Defense contractors donate to both parties, employ former officials from both sides, and operate in nearly every congressional district. Cutting defense is politically costly regardless of ideology. The same pattern appears in healthcare, energy, and technology. Pharmaceutical companies lobby against drug price controls while funding candidates across the spectrum. Energy companies shape environmental regulation while supporting both climate-friendly rhetoric and fossil fuel subsidies. Big tech donates broadly while influencing antitrust enforcement through legal and regulatory pressure. Public debate suggests fierce disagreement. Policy outcomes suggest negotiated continuity. This creates a feedback loop. To compete electorally, parties must raise money. To raise money, they must remain acceptable to donors. To remain acceptable, they must not threaten core interests. Over time, parties internalize these boundaries. Radical economic proposals are filtered out before reaching serious contention. What remains is a narrow band of responsible options that both sides can safely endorse. Cultural and social issues fill the gap. These areas allow sharp differentiation without destabilizing financial structures. Voters are offered intense symbolic conflict language, identity, values while economic policy operates on autopilot. This is not an accident. It is an equilibrium. It keeps participation high while risk remains low. Importantly, this system does not require politicians to be corrupt in a personal sense. Many genuinely believe in their platforms, but belief does not override incentives. When both parties are funded by overlapping economic interests, their room for divergence collapses. Elections become contests over management style, not ownership structure. Over time, voters sense this. They may not articulate it in technical terms, but they feel the sameness. Promises sound bold. Outcomes feel familiar. This fuels cynicism, polarization, and the rise of outsider movements that campaign against the establishment. Some in office, most, once inside, discover that the same financial and institutional pressures apply to them as well. The illusion of choice persists because it is functional. It preserves legitimacy without altering control. People vote. Parties rotate. Donors remain. Policy continuity is maintained, not through force, but through funding and incentives. By the time legislation reaches a floor, the most disruptive possibilities have already been removed. What survives is what both parties and their shared financial backers can live with. Different logos, same outcomes. And this leads to the final layer of illusion. If voters are choosing between parties that operate within the same donor-driven boundaries, then the real question is not which party wins, but who those boundaries ultimately serve. By the time you combine structural constraints with donor-driven incentives, the shape of the system becomes clear. What modern democracies offer is not open-ended choice, but managed choice. Voters are invited to select leaders, tones, and narratives, while the underlying economic framework remains largely untouched. This is the final layer of the illusion, the belief that choosing who governs is the same as choosing how the system works. Managed choice does not mean elections are fake. It means they operate within fixed rails. The public can decide who administers a machine, but not whether the machine exists, how it's financed, or who it ultimately protects. Those decisions are locked in by debt obligations, financial markets, institutional design, and global capital flows. Once these forces dominate an economy, democratic input becomes secondary. This explains why economic emergencies always seem to produce the same solutions. When banks fail, they are rescued. When markets crash, liquidity is injected. When inflation rises, rates are tightened. When growth slows, deficits expand. These responses are presented as technical necessities, not political choices, even though they redistribute wealth on a massive scale. Asset owners are stabilized. Wage earners absorb volatility. Savers are diluted through inflation. This pattern repeats regardless of the party in power. Crucially, the system requires public consent to function. Managed choice is how that consent is maintained. Citizens must believe they are participating meaningfully, even if the scope of participation is narrow. Elections provide legitimacy, not leverage. They renew the social contract without renegotiating its terms. This is why frustration with politics rarely translates into structural change. Voters blame leaders, not systems. When outcomes disappoint, they demand different politicians rather than different rules. The system absorbs this anger, rotates personnel, and continues. Stability is preserved, but at the cost of long-term trust. It is also why reform is so difficult even when problems are widely acknowledged. Everyone knows debt levels are unsustainable. Everyone knows housing is unaffordable. Everyone knows inequality is corrosive. Yet meaningful solutions threaten the same structures that keep the system running. Reducing asset inflation hurts balance sheets. Restructuring debt destabilizes markets. Limiting capital mobility undermines growth narratives. Each fix carries systemic risk, so incrementalism wins by default. This does not mean the system is evil or intentionally deceptive. It is a logical outcome of complexity. Modern economies are enormous, interconnected, and fragile. Once they reach a certain scale, preserving stability becomes the overriding objective. Democracy adapts to that objective by narrowing the range of acceptable outcomes while preserving the appearance of open choice. Understanding this changes how responsibility is assigned. It is comforting to believe that one party is uniquely corrupt or incompetent. It is harder to accept that both are operating inside the same structural cage. Blame becomes personalized because systemic critique feels abstract and disempowering. But personalization prevents diagnosis. You cannot fix what you refuse to name. The illusion of choice also reshapes individual behavior. When people realize that voting does not significantly alter economic outcomes, they disengage or radicalize. Some withdraw entirely. Others invest emotionally in symbolic battles, because symbolism is where differences still exist. Meanwhile, economic policy continues to be shaped elsewhere by forces that do not run for office. The uncomfortable truth is that modern democracies are increasingly managerial systems. They manage decline, risk, and distribution rather than enabling collective economic direction. Elections decide who communicates the constraints, not whether the constraints apply. The gap between democratic expectation and economic reality widens, and trust erodes further. So what does this mean for the individual? It means understanding the system as it is, not as it is marketed. Political participation still matters, but it is not sufficient. Expecting elections alone to deliver economic security is a category error. The levers that shape outcomes operate above and beyond the ballot box. This realization can feel bleak, but it also clarifies. When you stop expecting salvation from politics, you begin to ask different questions. Where is power actually exercised? How do incentives shape behavior? Which risks are socialized and which are privatized? And how should individuals position themselves in a system designed for stability, not fairness? The illusion of choice persists because it works. It keeps societies functional in the short term. But as economic pressures intensify, that illusion becomes harder to maintain. When outcomes remain the same no matter who wins, people eventually notice. And when they do, the real test is not whether democracy survives, but whether it evolves beyond choosing managers of a system it no longer controls.